You've probably heard of bank stress tests, right? They're one of the most important tools we have to prevent another financial meltdown. But what actually goes on inside one? Well, it's not just a bunch of people guessing. It's a highly sophisticated simulation, a financial fire drill really, designed to see if our biggest banks can take a massive economic punch. Today, we're going to pry open that black box and see how these critical models actually work.
So, here's our game plan. First, we'll explain what we mean by a financial fire drill. Then, we're going to look at the two big pieces of the puzzle, how we model a bank's loans, and then how we model its earnings. After that, we'll take a peek inside the modeler's toolkit itself, and finally, we'll wrap it all up by talking about why this whole drill matters so much.
All right, let's jump right in. This whole idea of a financial fire drill, what's it really about? Well, it all kicks off with one huge, fundamental question.
I mean, this is the multi-trillion-dollar question, isn't it? Because when a major bank goes under, it doesn't just stay on Wall Street. It hits jobs, it hits our savings, it affects the entire economy. We all learned that the hard way back in 2008. So how on earth do you keep those dominoes from falling in the first place?
The answer is surprisingly simple. You practice. Regulators basically cook up an absolute nightmare scenario. We're talking unemployment through the roof, the stock market getting cut in half, and house prices just cratering. Then, they feed that disaster into their computer models to see if a bank's financial cushion, its capital, is big enough to absorb the hit without needing a taxpayer bailout.
Okay, so the alarm is blaring, and our fire drill is officially on. The very first thing you have to check is the biggest source of danger for any bank, its loan portfolio. When the economy tanks, how many of those loans, from mortgages to credit cards, are just going to go up in smoke?
The main objective here is to calculate the total amount of money the bank is expected to lose from all its loans. And to figure that out, for everything from a simple car loan to a massive corporate loan, you have to break the problem down into three key pieces.
First up, what's the actual chance a borrower just stops paying? That's what we call the probability of default, or PD for short. You know, for someone with a perfect credit score, this is usually super low. But in a brutal recession, that probability starts ticking up for pretty much everyone.
Okay, but what if they do default? How much money does the bank actually lose? That's the loss given default, or LGD. Think about it. If a $300,000 mortgage goes bad, the bank doesn't automatically lose the whole $300,000. If they can foreclose and sell the house for $250,000, their actual loss, the LGD, is just $50,000. It's the part they can't get back.
And the last piece of the puzzle is, how much did the person owe at the very moment they defaulted? For a regular loan, that's pretty simple. It's just the remaining balance. But for a credit card, it's whatever balance they'd run up right before they stopped paying. That's the exposure at default, or EAD.
And here's where the magic happens. You just take those three things and multiply them together. The chance of default times the chunk of the loan you'll lose if they do, times the total amount they owe. PD times LGD times EAD. That gives you the expected loss. And modelers do this for millions and millions of loans to get the big picture.
Now this is absolutely crucial. This isn't some generic formula they slap on everything. Oh no. The model is specifically tailored to each type of loan. For mortgages, it's all about house prices and credit scores. For credit cards, the big driver is the unemployment rate. And for corporate loans, it's looking at things like bond spreads. This level of detail is exactly what makes the simulation so powerful.
Okay, so we've looked at the money going out the door from bad loans. But that's only half the story, right? A bank is still a business. Even in a crisis, it needs to be making money to stay alive. And that brings us to the second pillar of the stress test, predicting its profitability.
Think of it like a set of scales. On one side, you have all those potential loan losses, all the money flowing out. And on the other side, you have the bank's core earnings engine, the money that's still flowing in from its day-to-day business. That earning power has a fancy name, pre-provision net revenue, or PPNR.
Yeah, PPNR, it sounds super technical, but let's just break it down real quick. Pre-provision just means this is the bank's profit before we subtract all those loan losses we just talked about. And net revenue is just its basic profitability, all the interest it earns plus all the fees it collects minus its costs like salaries and rent. It's the bank's engine.
So the big question is, how do you predict what that engine is going to do when the economy is in a nosedive? Well, modelers basically have two main tools in their toolkit to figure that out.
You can kind of think of it like this. Regression models are like looking back at decades of historical weather data to find patterns and predict rain.
Structural models, on the other hand, are like using the laws of physics to calculate exactly when the sun will rise. One is based on past patterns, the other on fixed rules. These regression models are really the workhorses of the stress test. They dig through tons of historical data to find these really stable relationships. For example, a model might figure out that for every 1% drop in GDP, a bank's income has historically dropped by, say, 2%. They then use those patterns to predict what will happen in the new crisis scenario.
And then you have structural models. These are for the no-brainers, the parts where the rules are crystal clear. If a bank owns a bond that is contractually obligated to pay a 5% coupon, you don't need a fancy model to guess the income. You just calculate it. It's for the parts of the business that are totally predictable.
All right, we've gone through loan losses, we've talked about core earnings, we've peeked inside the toolkit, so let's zoom out and talk about why this whole complex fire drill really matters.
So at the end of the day, what's the bottom line? All of this incredibly complex modeling, from the PD, LGD, and EAD on loans to the PPNR earnings engine, it all boils down to one single crucial question. When the storm hits, is this bank strong enough to stand on its own, or will it need to be rescued?
But here's the thing to really chew on. All of this, it's built on models. And models are just sophisticated assumptions about the future. They are, without a doubt, incredibly powerful tools for making our financial system safer. But it leaves us with a really important question. As we get better and better at these simulations, how do we make sure they're actually making us safer and not just giving us a false sense of security?